Welcome to JS Online Teachers. Today in accounts we'll be looking at final accounts. So final accounts is defined as a summary of financial reports that are prepared by business organization and businesses at the end of the year. And these financial accounts actually shows two things. They actually show the financial performance of the organization. They also show the financial position at the end of the financial year. And the final accounts are also referred to as financial statements. So these financial reports are called final accounts because they are prepared at the end of the financial year. And we must take note that all the information that is recorded in the financial statement is only prepared after we have prepared the trial balance, or the information is obtained from the trial balance. In fact, we can say that these financial statements are prepared after all the adjustments have been made to the balances that appear in the trial balance. So those are the points that you must take note when we are looking at final accounts. So let us write down some notes. So I've actually said final accounts is a summary of financial reports that is prepared by business enterprises or organizations. At the end of the year, so this is the definition of final accounts. So we have actually said that these final accounts are also referred to as financial statements. So we can say final accounts are also referred to as financial statements. And I actually said that these final accounts actually shows two things. They actually show the financial performance. They also show the financial position. So we can say they actually show two things. So the financial performance and financial position. And we have also said that the financial reports are called final accounts because they are prepared at the end of the year. We have also mentioned that the information that is prepared in the financial statement, or the information that appears in the financial statements, is obtained from the trial balance. So those are the points that we have actually mentioned with our introductory part for final accounts. So let us look at the types of financial statements. So the types of financial statements, so we have three types. So the first one, we have the income statement. So this income statement is also referred to as the trading profit and loss account. So we can say trading profit and loss account. Then we also have the balance sheet. Then we also have the cash flow statement. So we'll start with the first financial statement, which is the income statement. So we're going to start with our income statement. So the income statement is also referred to as the trading profit and loss account. That's the first part that you need to take into consideration. So this is referred to as the trading profit and loss account. So the income statement actually shows the gross profit or loss of the business. It also shows the net profit or loss of the business. And this income statement is actually divided into two parts. It's actually divided into the trading account. It's also divided into the profit and loss account. So I've actually mentioned that the income statement actually shows, so this shows gross profit or loss. It can also show, it shows the net profit or loss. And I've actually said the income statement is divided into two parts. So this is divided into two parts. So two parts. And I've actually mentioned it's divided into the trading account So the trading account, this actually shows the gross profit or loss. Then it's also divided into the profit and loss account. So the profit and loss account, this actually shows the net profit or loss. So here, since we have actually mentioned that the income statement is also referred to as the trading profit and loss account, we have also said that this actually shows the gross profit or loss. It also shows the net profit or loss. And we have actually said that this income statement is divided into two parts. So we have the trading account, which actually shows the gross profit and loss. We also have the profit and loss, and this actually shows the net profit or loss. And since we have actually talked about this, we are going to go further and we're going to talk about the trading account. So the trading account actually shows the gross profit or loss of the business. So those are the most important things that you need to take into consideration. So this actually shows the gross profit or loss of the business. And we actually know that trading actually involves selling and buying of goods and services. That means that all the transactions that involves buying and selling of goods and services are recorded into the trading account. So the gross profit can be, the gross profit is found when the net sales is greater than the cost of sales. Then the gross loss is actually found when the cost of sales is greater than the net sales. So the most important formula that we need to take into consideration when we're talking about the trading account, we know that this actually shows, this shows the gross profit or loss. And the formula that we can use when finding the gross profit or loss, we actually say, so we can say net sales minus cost of sales. So this is the formula that we use, and actually said that the gross profit is found when the net sales is greater than the cost of sales. Then the gross loss is actually found when the cost of sales is greater than the net sales. In other ways, we can say that the gross profit is found when the selling price is greater than the cost of goods sold, or we can also say that the gross loss is found when the cost of goods sold is greater than the selling price. So those are some of the information that you need to take into consideration. And since we have written down our first formula, we have to break down this formula. So we are going to start with net sales. So the formula for net sales, this is equal to sales minus sales retains. Sales retains is also referred to as retains inwards. So this is the formula for net sales. So sales minus sales retains or retains inwards. So what are sales? So sales is the value of goods that have been sold by the business, and these goods were actually bought by the business for resale. So that's sales. Then for the sales retains or retains inwards, this is the value of goods that have been retained to the business by its customers. So the difference between sales and sales retains gives the net sales. Where you have questions, please ask in the group. So with the income statement, we started with the trading account, and we said that the trading account shows the gross profit or loss of the business, and we said that the gross profit or loss of the business is equal to net sales minus cost of sales, and we said that our net sales is equal to sales minus sales retains or retains inwards. So these are the formulas that we use. So we actually say that gross profit or loss is equal to net sales minus cost of sales, and we said that net sales is equal to sales minus sales retains or retains inwards. So since we have broken down this part of the formula, the first part of the formula, let us break down this other part of the formula, which is cost of sales. So the formula when finding cost of sales, so cost of sales is equal to, we're going to have our opening stock plus net purchases then plus carriage inwards then plus wages then minus closing stock. So this is the formula that we use. So cost of sales is equal to open bracket opening stock plus net purchases plus carriage inwards plus wages close bracket minus closing stock. So for the opening stock, this is the value of stock that the business brings forward to the current period from the previous accounting period. So for example, if the stock for last year when the business was closing was at 20,000, that means that and if we say that this 20,000 kwacha was for last year, which means this is 2022. That means that this year, which is 2023, this is going to be the opening stock. And 2023, the opening stock is going to be 20,000. So this is going to be the opening stock. So the opening stock is just the value of stock that the business brings from the previous accounting period. That's opening stock. Then for the net purchases, let us look at net purchases. So for the net purchases, this is found by saying purchases minus purchases returns So purchases returns can also be referred to as returns inwards. So for the purchases, we can say this is the value of goods that the business buys for resale. So the value of goods that the business buys with the intention of reselling, that's purchases. Then for the returns inwards, this is the value of goods that is returned to the suppliers. So when we say purchases minus purchases returns, we actually find the net purchases. So let us now look at carriage inwards. So carriage inwards is the amount of money that is spent on transporting goods or bringing the purchased goods into the business. And I'll give an example. For example, if we have company A, and this company A is located in Kafue, and it buys goods which it has to resell, and these goods are bought in Kawe. And for example, these goods are worth 50,000. And in transporting these goods which are worth 50,000 from Kawe to Kafue, this company A spends, for example, a 1,000. That means that 1,000 is the amount of money that is used on transportation, and this is going to be referred to as carriage inwards. And this money is going to be spent by company A in transporting goods worth 50,000. So this 1,000 has to be added to purchases. So that's the term carriage inwards. Let us look at the other term that we have in the formula. So wages. So wages is the irregular payment or non-fixed payment that is paid to workers. And this is paid to workers according to the amount of work that they do or according to the duration of time they work. So this is for wages. It is irregular and non-fixed. Non-fixed payment given to workers, and this can be according to the duration or the amount of work. So that's wages. And this type of work can be loading or offloading the goods. So for example, if these types of goods, when loading them and offloading them into a truck, it actually costed company A, for example, it actually costed them a 500 kwacha. That means that this 500 kwacha, we are going to count it as wages, and this has to be added to purchases. So that's wages. But sometimes when you're writing down your financial statements, you're going to discover that you'll be given, for example, this type of account, you'll be given wages and salaries. That means that this type of account is an indirect expense, and this has to be shown in the profit and loss account. But in a case whereby you have been given wages, this has to be shown in the trading account, and it has to appear on this formula. Then in this equation or in this formula, we have closing stock. So closing stock is the value of goods that this is the value of stock that has remained unsold during the period. So that's closing stock. So let us now look at cost of goods available. So the formula that we use on this one, we are going to say opening stock plus net purchases plus carriage inwards plus wages. So this is the formula that we use when calculating cost of goods available. Then from this formula we can say that cost of sales can be calculated by saying cost of goods available minus closing stock. So this is just the introductory part of the trading account. I hope like everything is clear, but where you have questions, please ask in the group. So let us continue looking at the trading account, and for us to solve this problem, we are going to use the formulas that we have talked about. So we have the question that we need to solve, and for this question we have opening stock amounting to 150, we have purchases amounting to 45, we have sales amounting to 550, we have retains inwards amounting to 50, we have retains outwards amounting to 5, we have carriage inwards amounting to 25, we have wages amounting to 20, we have stock, closing stock amounting to 25. Then we are supposed to find the net sales, net purchases, cost of goods available, cost of sales, and gross profit. So we are going to start with our A. So our A, we are supposed to calculate the net sales. And for us to calculate the net sales, we know that we use the formula sales minus sales retains. And we know that our sales retains can also be referred to as the retains inwards. So the retains inwards. So we know that sales we have 550 there. So we're going to say 550 minus retains inwards. Retains inwards we have 50. So 550 minus 50, our answer is going to be 500 kwacha. So that's going to be our net sales. So let us find our net purchases. So net purchases, we know that we use the formula purchases minus purchases retains, and purchases retains can also be referred to as retains outwards. So say retains outwards. And purchases, what do we have? Purchases, we have 45 there. So say 45 minus retains outwards. Retains outwards, we have 5 kwacha. So if we say 45 minus 5, we're going to have 40 kwacha. So that's going to be our net purchases. Then let us find the cost of goods available. So the cost of goods available, we use this formula. We say opening stock plus net purchases plus carriage inwards then plus wages. So this is the formula that we use: opening stock plus net purchases plus carriage inwards plus wages. So we are going to say our opening stock. Our opening stock, we have 150. So we'll say 150 plus net purchases. Net purchases, we had calculated 40 there. So we'll say 40 plus our carriage inwards. Our carriage inwards we can get from our equation. We know that's 25 plus wages. Wages, we have 20. So we are going to say 150 plus 40 plus 25 plus 20. Our answer here is going to be 235. So that's going to be cost of goods available. Let us find our D, which is cost of sales. So cost of sales is calculated by saying cost of goods available minus closing stock. Minus closing stock. So here we can say cost of goods available. Cost of goods available we had calculated as 239. So we'll say 235 minus closing stock. Closing stock we had calculated, closing stock we have in our question, which is 25. So we'll say 25 there. So we can say 235 minus 25, our cost of sales is going to be equal to 210. Then let us find the gross profit. So we know, we say our gross profit by saying net sales minus cost of sales. So we can say our net sales, net sales there we had calculated as 500. So we say 500 minus cost of sales. Cost of sales we had calculated as 210. So 500 minus 210 there, we have 290 kwacha. So that's how you can calculate the net sales, the net purchases, cost of goods available, cost of sales, and the gross profit. And to go through these formulas again, we actually said that net sales is calculated by saying sales minus sales retains, and sales retains are also referred to as retains inwards. Then for net purchases is purchases minus purchases retains, which are also referred to as retains outwards. Then we have cost of goods available. So for cost of goods available, the formula is opening stock plus net purchases plus carriage inwards plus wages. Then we have cost of sales. So for cost of sales is cost of goods available minus closing stock. Then for gross profit is the formula is net sales minus cost of sales. So that's how you can find this question. Where you have questions, please ask in the group. So this program has been brought to you by Jos Wale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless. So today in accounts, we'll continue looking at the trading account, and we're going to look at the formatting of the trading account. So this is how we can write down the formatting of the trading account. So as you can see, we have 4 columns. So we have the first column, we have the second column, we have third column, and the last column. So here we can say title. title of trading account. And the first item that we record there, we say sales. So we'll put our sales there. And our sales, we're going to record them in this column. Then we're going to say less sales retains. And we know that sales retains are also referred to as retains inwards. So we'll put there. And when we find the difference there, we're going to get this answer. So this answer is referred to as net sales or turnover. Then after you do that, then you're going to say less cost of sales. Then you're going to start with your opening stock. So opening stock we're going to put here. Then you're going to say purchases. Purchases you're going to put here. Then you say less purchases retains. And we know that purchases retains are also referred to as retains outwards. So less purchases retains. So when we find the difference there, we are going to get net purchases. Then, since we are following the net purchases, then we can say add direct expenses. In the direct expenses that can be incurred by the business include carriage inwards and wages. So we're going to add direct expenses. So when we add these figures, we're going to get an amount here. Then we're going to add our opening stock with this figure, and we're going to get cost of goods available. So this is going to be cost of goods available. And since we have cost of goods available, we can say less closing stock. And less closing stock there, we have to find the difference. So let us continue to this side. So we can continue that side. So we'll say cost of goods available, less closing stock, and we're going to have cost of sales. And the cost of sales, we're going to put them in the last column. And that means that we need to find the difference between net sales and cost of sales. And the answer that we're going to get is gross profit. So this is going to be the formatting of the trading account. And for you to understand this formatting, the only thing that you're supposed to do is to understand the formulas. So if we start with the first part of this table, we have sales minus sales retains. And when we started looking at the trading account, we said that the formula that we use when calculating net sales, we say this is equal to sales minus sales retains. And as you can see, like this formula, you can see it from here. It is sales less sales retains, and we have net sales or the turnover. We also said that we can calculate cost of goods available for sale. We said that we can use this formula. We said we can say opening stock plus net purchases, then plus carriage inwards plus wages. So we can see this part of the formula in our table. So here I said less cost of sales. Then as you can see, we have opening stock. So we have our opening stock there. Then we said purchases less purchases retains. In this part of the formula, you can see it. This part of the information, you can see it in the formula, which is this part. So which is the net purchases. So that's the net purchases there. Then it says add direct expenses. And the direct expenses there, we are meaning carriage inwards and wages. And if you do that, we're going to have cost of goods available. Then the other part of the formula that you need to understand, we said cost of sales is equal to cost of goods available less closing stock. So you say cost of goods available less closing stock. In this part of the formula, you can see it in the table. We said cost of goods available, which is this figure, less closing stock, which is that figure, and we're getting cost of sales, and we find the cost of sales this side. Then the last part of the formula that you need to understand is gross profit is equal to net sales minus cost of sales. And this part of the formula, you can see it in the table. You just say net sales, which is also referred to as turnover, minus cost of sales, and we're getting the gross profit there. So this is the formatting of the trading account. Where you have questions, please ask. Let us now look at an example for the trading account. So we have this example that we're going to use, and you can read the example on the screen. So the example reads, from the following trial balance of Alexi, you are required to draw up a trading account for the year ended 30th June 2003. So we have that trial balance. So we have sales amounting to 678. We have purchases amounting to 145. We have retains inwards amounting to 123. We have retains outwards amounting to 50. We have carriage inwards amounting to 100. We have stock amounting to 200. We have rent amounting to 45. We have advertising amounting to 237. We have electricity amounting to 75. We have building amounting to 200. We have furniture amounting to 17. We have debtors amounting to 23. We have creditor amounting to 250. We have drawings amounting to 19. We have bank loan amounting to 423. We have cash amounting to 345. We have bank amounting to 450. We have capital amounting to 671. We have wages and salaries amounting to 134. Then we have discount allowed amounting to 67. We have discount received amounting to 89. We have rent received amounting to 34. We have carriage outwards amounting to 17. Then the inventory at 30th June 2003 was 145. So we are supposed to prepare the trading account for Alex. So the first thing that you're supposed to do is to put up the title. So I've written the title here, and the title is going to read Alex C trading account for the year ended 30th June 2003. So that's the first step that we're going to do. And since we have been given this trial balance, we need to identify the items that are placed in the trading account. So we'll start with sales, and sales amounted to 678. And since we have our returns inwards in our question, that means that we're supposed to subtract them from sales. So we are going to say less returns inwards, and this amounted to 123. So we're going to say 678 minus 123. Our answer there, we're going to have 555, and that's going to be called our turnover or net sales. Since we have recorded our turnover or net sales, the next thing that you are going to do, we're going to say less cost of sales. Then we are going to start with our opening stock. So if we check in the question there, our opening stock is 200. So we're going to put our 200. Then the next thing that we're supposed to record is our purchases. And our purchases amounted to 145. And since we have returns outwards, that means that the returns outwards, we have to subtract them from purchases so that we can get our net purchases. So we're going to say less returns outwards. And our returns outwards there, we are having 50. So we're going to say 145 minus 50, we're going to have 95. And that's going to be called net purchases. And since we have calculated our net purchases, now we are supposed to identify the direct expenses. And examples of direct expenses, we have carriage inwards and wages. And since in our question, we only have carriage inwards, that means that we're going to add carriage inwards. We don't have wages. So we'll say carriage inwards. And we have to take note of something. The wages that we are having, this wages is combined with salaries. That means that in this case, this is going to be an administrative expense and it's not going to appear in the trading account. So that means that we're just going to add our carriage inwards, and our carriage inwards there, we're having 100. So we're going to say 95 plus 100 there, we're going to have 195. And there we can add our 200 plus 195. So we're going to get cost of goods available for sale. So cost of goods available. So say 200 plus 195. So we're going to have 395. So we can continue this side. since we have calculated our cost of goods available, then we have to say less closing stock. So for you to differentiate between the closing stock and the opening stock, the opening stock, you're always going to find it in the trial balance. Then the stock that is given outside the trial balance, that's going to be your closing stock. So if we check there from our question, our closing stock, we're having 145. So we are going to say less closing stock, which is 145, and we're going to say our cost of goods available, we're having 395 minus our closing stock, which is 145. So there our answer, we are going to have 250, and our 250, that's going to be cost of sales. And there now we can calculate the gross profit or loss. Since in our case our net sales is greater than cost of sales, that means that we're going to find our gross profit. So we'll say 555 minus 250, our answer, we're going to have 305. So that's going to be our trading account. Where you have questions, please ask in the group. So this program has been brought to you by Jos Wale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless. Welcome to JS Online Tuitions. So today in accounts, we'll be looking at the profit and loss. So most of the businesses, they mistake the profit they make after subtracting the cost of goods sold from the revenue that is generated from goods sold to be their final income. This makes these businesses to spend most of this money on personal matters, only to get surprised by the landlords coming on their door, asking them to pay rent, asking them to pay water bills, asking them to pay electricity bills. These types of businesses collapse eventually. So it is very important to look at the profit and loss account. So the profit and loss account, this is a financial statement that is prepared by businesses to show the net profit or loss of the organization. And the profit and loss account is only prepared after calculating the gross profit. So we can say the profit and loss account is the second part of the income statement. So let us write down these notes on our whiteboard. So I've said most of the businesses mistake the profit they make after subtracting the cost of goods sold from revenue that is generated from goods sold to be their final income. To be their final income. So most of the businesses mistake the profit they make after subtracting the cost of goods sold from revenue that is generated from goods sold to be their final income. So this makes these types of businesses to spend most of their money on personal matters. So these type of businesses spend most of their money on personal matters only to get surprised by the landlords chasing them from the business buildings due to lack of payment of rent. Then we can say water bills, electricity bills, and many more. So this type of businesses spend most of their money on personal matters only to get surprised by the landlords chasing them from the business building due to lack of payment of rent, water bills, then electricity bills, and many more. So these types of businesses, they will collapse eventually. So these types of businesses will collapse eventually. These types of businesses collapse at the end. So due to these reasons, these types of businesses collapse at the end. So due to the reasons that I've given, so it is important to look at the profit and loss. And I've said that the profit and loss account, this is the financial statement that is prepared by businesses to show the net profit or loss of the organization. So it is important to look at the profit and loss account. Then I've said the profit and loss account, it is a financial statement that is prepared by businesses to show the net profit or loss. To show the net profit or loss. And we can say that the profit and loss account is only prepared when the gross profit has been recorded or calculated, and we can say that the profit and loss account is the second part of the income statement. So here we only prepare the profit and loss when the gross profit or loss has been prepared. So we can say profit and loss account is prepared after calculating the gross profit or loss. And due to this reason, we can say the profit and loss account is the second part of the income statement. So the profit and loss account is the second part of the income statement. And since we have looked at the definition of the profit and loss, let us now look at on how we can calculate the net profit or loss. So the net profit or loss can be calculated by subtracting the operating expenses, which are also referred to as the indirect expenses, from gross profit. So we can use this formula. We can say net profit or loss is equal to gross profit minus operating expenses. So from this formula, we can take note that we can only find the net profit if gross profit is greater than operating expenses. And from this same formula, we can say that our net loss can be found when the operating expenses are greater than the gross profit. So that's the formula that we use. So from this same formula, so we have said net profit or loss is equals to gross profit minus operating expenses. So we can see that this first part of the formula, which is the gross profit, this is obtained after calculating the trading account. So we obtain the gross profit after calculating the trading account, and we said that the formula for gross profit is equal to net sales minus cost of sales. So let us now look at operating expenses. So let us look at operating expenses. So the first thing that you're supposed to know with operating expenses is that operating expenses are also referred to as indirect expenses. So operating expenses can be defined as these are costs that are incurred by businesses on services that help in running the organization. So that's the definition of operating expenses or indirect expenses. And this can be divided into three parts. So we have selling and distributing expenses, we have office and administrative expenses, then we also have financial expenses. So let us write down these expenses. So I've said that the first thing about the operating expenses is that these are also called indirect expenses. Then the operating expenses are costs incurred by businesses on services that help in running the organization. So that's the definition, and I've said that these operating expenses can be divided into three types. I've said they can be divided into selling and distributive expenses, then we also have administrative expenses, then we also have financial expenses. So we're going to start with the first one, which is selling and distribution expenses. So with this type of expenses, what are we talking about? So here we are talking about bad debts. We are also looking at carriage outwards. Then we're also looking at commission allowed. Then the other example we have advertising. Then we also have packaging expenses. So these are the examples on selling and distribution expenses. Let us look at the second type of operating expenses. So here we have office and administrative expenses. So when we talk about office and administrative expenses, what do we mean? So here we are looking at insurance, we are looking at rent, then we are also looking at printing and stationery, we are also looking at salaries and wages, and many more. So these are just examples for office and administrative expenses. Then let us look at the other type. So the other type that we are having financial expenses. So for the financial expenses, here we are looking at repairs, then we're also looking at depreciation of fixed assets, then we're also looking at interest on loan, we are also looking at discount allowed. So these are some of the examples for operating expenses. Where you have questions, please ask in the group. Let us now look at income or gains. So most of the revenue that is generated by businesses is obtained from sales. But in some cases, the businesses can generate income which is not coming from sales. And such type of income is referred to as additional income or supplementary income. So whenever the business has additional income, those types of income have to be added to the gross profit before subtracting the operating expenses. So the first thing that we're going to do, we're going to add the gross profit plus additional expenses. After we find our figure, that's when we'll subtract the operating expenses to find our net profit or loss. So that's our income or gains. So I've said most of the income that is generated by the business comes from sales, comes from sales, but the business can have other types of income apart from sales, and those types of income are referred to as additional or supplementary income. So we can say the business can have other sources of income apart from sales, and these are referred to as additional income. Referred to as additional income or supplementary income. And how we record the additional income or supplementary income, they have to be added to the gross profit before subtracting the operating expenses. So the additional income has to be added to the gross profit before subtracting the operating expenses. And we can look at some of the examples of additional income or supplementary income. So if we are talking about examples, these include, we have rent income, then we have dividend received, then we have discount received, then we have commission received, then we also have interest on deposit. So interest on bank deposit. So these are examples of additional or supplementary income. Where you have questions, please ask in the group. So if we are to consider additional or supplementary income, we have to adjust our formula for net profit or loss. So net profit or loss is going to be equal to gross profit or loss plus supplementary income, then minus operating expenses or indirect expenses. So that's going to be the formula. So we can say net profit or loss is equal to gross profit plus supplementary income. So you have to put gross profit plus supplementary income in brackets, then minus operating expenses. So this is going to be the formula. So let us now look at this example that is going to help us to calculate the gross income, to calculate the operating expenses, to also calculate the net profit or loss. So the example reads, Hope had a gross profit of 890 during the year ended 31st September 2023. The following balances were also obtained. So we have rent amounting to 150, advertisement amounting to 100, wages and salaries amounting to 75, insurance amounting to 100, stationery amounting to 70, discount allowed amounting to 250, rent received amounting to 105, discount received amounting to 55. So we are going to start with our first question, which is gross income. And the formula for gross income is gross profit plus supplementary income. So let us identify our gross profit. Our gross profit will be given as 890. Then plus our supplementary income. For supplementary income, we only have two. We have rent received amounting to 105. We have discount received amounting to 55. So we're going to see 105 plus 55. So we'll say 890 plus 105 plus 55, we're going to have 160. So 890 plus 160, we're going to have 1050 kwacha. So that's going to be our answer. Let us look at Roman numeral 2. We have operating expenses. And for operating expenses, we have said that these are costs that are incurred by businesses on services that help to run the business. And we have said examples of operating expenses. We have selling and distributive expenses. We have administrative expenses. Then we also have financial expenses. So let us find these expenses. So operating expenses, our expenses there, we're going to have rent, we're going to have advertisement, we're going to have wages, we're going to have insurance, stationery, and discount allowed. So we're going to have 150 plus 100 plus 75 plus 100 plus 70 plus 250. Then to just classify these types of expenses, we can say rent there, this is administrative, advertisement, this is selling and distribution, then wages, that's administrative, insurance, that's administrative, stationery, that's administrative, then discount allowed, that's financial. But that's not important. Our important thing here, we're just supposed to calculate operating expenses. So we're going to say 150 plus 100 plus 75 plus 100 plus 70 plus 250. Our answer, we're going to have 745. Let us look at Roman numeral 3. Roman numeral 3, we are supposed to calculate the net profit. And we said that the net profit can be calculated when the gross income is greater than operating expenses. And we can see that our gross income there, we're having 1005, and this amount is greater than operating expenses, which are amounting to 745. So say gross income minus operating expenses. So there our gross income we have calculated as 1050. So 1050 minus operating expenses, we are having 745. So 1050 minus 745, we're going to have 305 as our net profit. So where you have questions, please ask in the group. Let us now look at the formatting of the profit and loss account. So let us now look at the formatting of the profit and loss account. So the first thing that we're starting with is the gross profit. So we're going to put our gross profit here. Then we're going to say add income, and this income can be rent received, rent income, can have rent income, then we can have dividend received, then we can have discount received, then we can also have commission received, can also have interest received. So these are some of the examples of income. So when we add these, we're supposed to have total income, and our total income is going to appear there. So we're going to add our gross profit plus our total income. So we're going to find the gross income. So the total that we get after adding the gross profit plus total income, we're having gross income. Then we're going to say less expenses. And for the expenses, we can have rent. We can put our rent there. We can have stationery. We can also have insurance. We can have carriage outwards. And many more. There are a lot of expenses. So when we add these expenses that we are having, we're going to have total expenses. So we can say total expenses. Then since we have our total expenses, we can subtract the total expenses from gross income, and the answer that we're going to have is net profit or loss. So say net profit or loss. We are going to have our answer there. So this is the formatting of the profit and loss. Where you have questions, please ask in the group. So let us continue looking at the profit and loss. Now we're going to consider the example that we gave for Hope to calculate our profit and loss account. So this is the example that we had. So the question reads, Hope had a gross profit of 890 during the year ended 31st December 2023. The following balances were also obtained. We have rent amounting to 150, advertisement amounting to 100, wages and salaries amounting to 75, insurance amounting to 100, stationery amounting to 70, discount allowed amounting to 250, rent received amounting to 105, discount received amounting to 55. So we have been told to calculate the profit and loss account for Hope. So the first thing that I have done is to write down the title, and the title is going to read Hope Profit and Loss Account for the year ended 31st September 2023. And the first thing that we're going to do is to record the gross profit. In the gross profit, we have been given as 890. So we're going to put our 890 here. Then we have to identify from our questions if you are having supplementary income. And you're having additional supplementary income, we're having rent receipt and discount receipt. So we are going to say add income. So the income that you're having, we have rent receipt, amounting to 105. Then we have discount receipt, amounting to 55. So when we add our 105 plus 55, we're going to get our 160. So our 160, that's going to be total income. So say total income. Then we can add the gross profit plus total income to get gross income. So say 890 plus 160, the answer that we're going to have 150. Since we have calculated our gross income, we can say less expenses. So less expenses. So we have to identify our expenses in the question. So identifying the expenses in the question, we have rent, advertisement, wages and salaries, insurance, stationery, discount allowed. So we're going to say rent. Rent, we had 150. Then advertisement, 100. Advertisement, 100. Then wages and salaries. So say wages and salaries, amounting to 75. Then we also have insurance, 100. Then we have stationery, 70. Then we have discount allowed, 250. So we'll say 150 plus 100 plus 75 plus 100 plus 70. We're going to have total expenses. So our total expenses, we're going to have 745. Since we have calculated our total expenses to be 745, so the next thing we are supposed to calculate the net profit or loss. And I said that you can find the net profit when the gross income is greater than total expenses. Then we can find the net loss when the total expenses are greater than the gross income. So considering in our case, our gross income there is greater than the total expenses, that means that we're going to find our net profit. In our net profit there, we're going to say 1050 minus 745. We're going to have 305. So we're going to have 305. So that's how you can write down the profit and loss for Hope. So to just summarize the profit and loss account, the profit and loss account is a financial statement that is prepared by businesses to show the net profit or loss. And this financial statement is prepared after calculation of the gross profit. And we can say that the profit and loss account is the second part of the income statement. And the formula that we use when calculating net profit or loss, we say net profit or loss is equal to gross profit minus operating expenses. But in the case whereby you have additional or supplementary income, you're supposed to add additional supplementary income to the gross profit. That is going to give you the gross income. Then after calculating the gross income, you say minus operating expenses. So that's a summary of the profit and loss account. Where you have questions, please ask in the group. And the next time that we're going to meet, we're going to look at the balance sheet. Thank you very much for your time. God bless. Bye-bye. So this program has been brought to you by Jos Wale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless. Welcome to JS Online Tuitions. Today in accounts, we'll continue looking at final accounts, and we'll be looking at the balance sheet. So the balance sheet is defined as a financial statement that shows the financial position of the business at a given period of time by comparing the business assets with the combination of the owner's equity and liabilities. So we can define the balance sheet as a financial statement that shows the financial position of the business at a given period of time by comparing the business assets with the combination of the owner's equity and liabilities. And this balance sheet is also referred to as a statement of financial position. That means that this balance sheet can show two instances. So the first instance, if the business assets are greater than a combination of the owner's equity and liabilities, that means that the business is having a good financial position, and that means that the business can use its assets to pay back debt. Then the second instance is when the combination of the owner's equity and liabilities are greater than assets. That means that that business is having a bad financial position, and that means that the business cannot use its assets to pay back debt. So let us write down these points on the whiteboard. So I've said the balance sheet is a financial statement that shows the financial position of the business at a period of time, at a given period of time. At a given period of time by comparing the business assets with a combination of of the owner's equity and liabilities. So this is the definition. So the definition of the balance sheet is a financial statement that shows the financial position of the business at a given period of time by comparing the business assets with a combination of the owner's equity and liabilities. And we have said that the balance sheet is also referred to as a statement of financial position. So the balance sheet is also referred to as a statement of financial position. And we have said that when the business assets are greater than a combination of the owner's equity and liabilities, that means that the business is having a good financial position, and that means that the business can use its assets to pay back debt. Then the other instance, we have said that when the combination of the owner's equity and liabilities are greater than the business assets, that means that that business is having a bad financial position, and that means that that business cannot use its asset to pay back debts. So let us write down those points. So when the business assets are greater than the combination of owner's equity and liabilities, that means that the business is having a good financial position, and meaning that it can use its assets to pay back debt. And the second instance, we have said when the combination of owner's equity and liabilities is greater than business assets, that business is having a bad financial position. So the business is having a bad financial position, and meaning that it can't use its assets to pay back debt, and meaning that it can't use assets to pay back debts. Let us now look at the accounting equation. So the balance sheet is based on the accounting equation. In the accounting equation, we have assets is equal to liabilities plus owner's equity. And this financial statement is referred to as a balance sheet because the two sides of the equation that I'm going to write down must always balance. And that means that the assets can be obtained by the business by either using two methods, so by either using liabilities or by using owner's equity. So for liabilities, we mean that assets can be obtained by borrowing money from outsiders, and for the owner's equity, we mean that the money that is invested by business owners. So let us write down these points. So I've said that the balance sheet is based on the accounting equation. So that's the first point. So the balance sheet is based on the accounting equation, and have said that the accounting equation can be written in this form. So we can say assets is equal to liabilities plus owner's equity. And I've said that this financial statement is referred to as a balance sheet because the two sides of this equation must always balance. And from this equation, we have seen that assets is equal to liabilities plus owner's equity. And that means that these assets can be obtained in two ways, either using liabilities or owner's equity. So for liabilities here, we mean the funds that are borrowed from outsiders and using those funds to purchase assets, or we can use owner's equity, and these are just funds that are invested by business owners. So this is the accounting equation. Where you have questions, please ask in the group. So we have said that the balance sheet is based on the accounting equation, and we have said that the assets is equal to liabilities plus owner's equity. And I've written this formula. So we have assets is equal to liabilities plus owner's equity. That means that we have to look at assets, we have to look at liabilities, then we have to look at owner's equity. So we're going to start with assets. So what are assets? So assets are defined as items or properties of value that the business owns, or they can be defined as these are properties that are used in business operation. And assets can be divided into two parts. So we have fixed assets and current assets, but assets can also be categorized into intangible assets. And we're going to look at fixed assets and current assets. So for the fixed assets, these are type of assets that are used in a business for a long period of time, and their lifespan is more than 1 year. Giving some of the examples of fixed assets, we have plant and machinery, we have land, we have building, we have motor vehicle, we also have furniture. Then let us look at the current assets. So for the current assets, these are type of assets that are used in a business for a short period of time, and their lifespan is less than 1 year. These types of assets usually change form, or they can be easily be converted into cash. Examples of current assets, we are having cash in hand, cash at bank, we are having debtors, or also having stock. And we are going to see for stock we can have raw materials, we can have work in progress, we can have unsold finished goods. We are going to look at those into details. Then I've also said that the assets can be categorized into intangible assets. So for the intangible assets, these are non-physical properties of value that the business owns. That means that this business can sell these non-physical possession in order for them to make profit. And examples of intangible assets, we have goodwill, we have patents or copyrights. We also have brand names of companies and businesses. So let us write down these notes. So I've said the assets. So for the assets, these are items or properties of value. Properties of value that the business owns. These can also be defined as properties that are used in operation of the business. And I've said that for the assets, this can be divided. This can be divided into current assets and fixed assets but we must also take note that these can also be grouped. This can also be grouped into intangible assets. So we'll start by looking at the current assets. So start with the current assets. So for the current assets, these are assets that are used in a business for a short period of time. So types of assets that are used in a business for a short period of time. Then we must also take note that this type of assets usually change form in the operation of the business. So these, they change form during business operation. And these can easily be changed into cash. They can be easily be converted into cash. And let us look at some of the examples. So examples. So the first example there, we have cash in hand. So cash in hand, that means that the business money at the business premises. So that's cash in hand. That just refers to the business money at the business premises. Then the other example, we have cash at bank. So this is the business money on the bank account. So the business money on the bank account. Then we also have debtors. So this is the amount of money that is the credit customers owe us. So this is the money that credit customers owes the business or us. Then we also have stock. And you must take note that when you are writing down the balance sheet, I know you're going to be given the trial balance, and in the trial balance, that's where you're going to use that information that you're going to record in the balance sheet. But you have to take note that there will be stock that's going to be shown in the trial balance. So that stock is not recorded under the current assets, but you get the stock that is outside the trial balance, and that stock is the closing stock. Then for the closing stock, or the stock that you're having, this can be raw materials. So you have to get raw materials of closing stock. This can also be work in progress. So we have work in progress. Or unfinished goods. Or we can have unsold finished goods. So unsold finished goods. So these are the types of assets. So I've said examples of assets. We have cash in hand, cash at bank, debtors, and stock. And if you have been told to classify these according to their liquidity, or which one is the most liquid here is cash in hand. That's the most liquid, then followed by cash at bank, then followed by debtors. But most of the people might be having the debate like which one is more liquid between debtors and stock. So debtors is more liquid because the goods have already been sold, and the only issue there is just receiving payment, and the payment can be made when it's demanded from the debtors. So from the debtors are more liquid than stock. But considering stock here meaning that the goods have not yet been sold. So the business is not sure whether those goods are going to be sold or not. So that means that stock is less liquid than debtors. But classifying these in terms of which one is most liquid, so we have cash in hand, cash at bank, we have debtors, and we have stock. Where you have questions, please ask in the group. So let us now look at fixed assets. So fixed assets, these are type of assets that are used in a business for a long period of time. So these are assets that are used in the business for a long period of time. And we can say their lifespan is more than 1 year. Let us look at some of the examples of fixed assets. So examples of fixed assets. So we are having plant and machinery. So plant and machinery. Then the other example, we have land. Then we are also having building. Then we are also having motor vehicle. So motor vehicle. Then we can also have furniture. So these are examples of fixed assets. So I've said plant and machinery, land, building, motor vehicle, furniture. Let us now look at liabilities. So for the liabilities, we know that when the business is starting, that means that it will need funds. And the funds that are going to be needed by the business that are going to be used in purchasing fixed assets. And some of the fixed assets have said we are having plant and machinery, land, buildings, motor vehicle, and furniture. So the business needs these funds in order to purchase this, but the business also needs the funds in order to finance working capital. And working capital is the amount of money that is used in the day-to-day operation of the business. And we said that from the accounting equation, we are having, from our accounting equation, we said we are having liabilities plus owner's equity. That's what we said. That means that when the business is starting, it will need funds, and these funds can either be obtained from the owner's equity or liabilities. And I've said that the business will need the funds in order to purchase the fixed assets. And some of the fixed assets I've said land, buildings, machinery, and plant. Then we also have furniture, but it also need the money in order to finance the working capital. In the working capital, that's the funds that are needed for the day-to-day operation of the business. So if the funds that are invested by the business owners are not enough to finance these things that I've mentioned, it's supposed to borrow some of the money from outsiders. So the process of borrowing money from outsiders, that's liabilities. So that's what's referred to as liabilities. And to define liabilities, liabilities are defined as debts or financial obligations that have to be paid back to outsiders. And these outsiders are not business owners. So that's the definition of liabilities. And liabilities can be divided into two parts. So we have current liabilities, and we also have long-term liabilities. So what do we mean when we say current liabilities? So current liabilities are defined as debts or financial obligations that have to be paid in a short period of time. And examples of current liabilities, we're having creditors and bank overdraft. Then looking at long-term liabilities, these are debts or financial obligations that have to be paid for a long period of time. And examples of long-term liabilities, we are having a bank loan and debentures. So let us write down these notes. So I've said when the business is starting, it will need the funds, and those funds can either be obtained from owner's equity and liabilities. So when the business starts, to operate, if it starts by using the owner's equity, and if the owner's equity is not enough, it's going to be opted to get the funds from outsiders. And the option of getting the funds from outsiders, that's referred to as liabilities. So we can say liabilities are financial obligations that have to be paid, back to the outsiders. And the outsiders, in this case, that means that these are not business owners. They're not involved in the business that you do. And I've said that the liabilities can be grouped into current liabilities and long-term liabilities. So liabilities can be grouped into current liabilities and long-term liabilities. So we'll start with the current liabilities. So the current liabilities. So the current liabilities, this is debts that has to be paid in a short period of time. So debt that has to be paid in a short period of time. And examples here, I've said we're having creditors and we are also having bank overdraft. So creditors here, this is just the amount of money that is owed to the suppliers. And for the bank overdraft is a situation where the business is able to withdraw more money than its bank balance. Then let us look at long-term liabilities. So these are debts or financial obligations that have to be paid in a long period of time. So this is debt that has to be paid in a long period of time. And let us look at some of the examples. Here we are having bank loan. Then we are also having debenture. So that's what we can talk about on current liabilities and on long-term liabilities and on fixed assets. Where you have questions, please ask in the group. So let us now look at owner's equity. So owner's equity is equal to assets minus liabilities, and I've already written down this formula. So we have owner's equity is equals to assets minus liabilities, and we're going to look at types of capital. So the first type of capital there that we are having capital owned or equity capital. And this type of capital can be found by, but before we look at the formula, this capital owned or equity capital is also referred to as owner's equity. So using the formula, we can say owner's equity is equal to assets minus liabilities. So this is the formula. But in a case where you have initial capital, then you are also having new capital, then you are also having net profit, and we know what net profit is. Then we are also having drawings. And drawings, we know that this is the amount of money that is withdrawn for personal use. So in a case where you have initial capital, then you have new capital, then you have net profit and drawings, our formula is going to change. So we are going to say owner's equity is equal to, so we are going to first add the initial capital plus the new capital, then when we find that total, we're going to say plus the net profit. And this net profit, that means that for this net profit, it is not distributed into dividend. So that means that it is brought back into the business. So we can say add net profit. Then when we find that total minus drawings, and we have said that drawings is the amount of money that is used for personal use, so minus drawings. So that can be the formula. So that's all about capital owned or equity capital. Let us look at the second type of capital. In the second type of capital, we have borrowed capital or loan capital. So borrowed capital or loan capital, this is the type of capital that is obtained from long-term liabilities. So we can say borrowed capital is equal to long-term liabilities. And for the long-term liabilities, we gave examples. We have a bank loan and debenture. So here for the borrowed capital, so borrowed capital is obtained from long-term liabilities. So borrowed capital is obtained from long-term liabilities, and that means that it can be obtained from bank loan and debenture. So can be obtained from bank loan and debenture. And giving the formula there for borrowed capital, we can say the borrowed capital is equal to long-term liabilities. Let us look at another form of capital. The other form of capital that we are having is working capital. So working capital are the funds that are needed in the day-to-day operation of the business. And working capital is equal to current assets minus current liabilities. That's the formula. So here we can say we are also having working capital. So working capital, these are funds that are used in the day-to-day operation of the business. So we can say funds or amount of money that is needed for the day-to-day operation of the business. So funds needed in day-to-day operation of the business. And this can be found by, so we can say working capital is equal to, so we can say is equal to current assets minus current liabilities. So working capital is equal to current assets minus current liabilities. We can also say that when the current assets are greater than the current liabilities, that means that we can find net current assets. So in this situation, we're going to find net current assets. But if this is the opposite, where the current assets are less than the current liabilities, that means that we're going to have net current liabilities. So where the current assets are less than the current liabilities, that means that we're going to have net current liabilities. So in this instance, we're going to have net current liabilities. So let us now look at the other type of capital, which is fixed capital. So fixed capital is the amount of money that is used to purchase fixed assets. So this is the amount of money that is used to purchase fixed assets. And examples of fixed assets, we having plant and machinery, we are having building, we are having land, we are having motor vehicle, we are also having furniture. So that's a fixed capital. And for the fixed capital there, we can say fixed capital is equal to fixed assets. Fixed assets. So that's the formula. Let us now look at liquid capital. So for the liquid capital, these are assets that can easily change form. So liquid capital, these are just assets that can easily change form. That's liquid capital. So assets that can easily change form, or can be defined as assets that can be converted into cash quickly. So assets that can be converted into cash quickly. And giving examples of liquid capital, there we are going to have cash in hand, which is more liquid, then followed by cash at bank. Cash at bank. Then also having debtors. We're also having stock. Although stock is the least liquid amongst these current assets. Then let us now look at the other form of capital. The other form of capital, we are having capital employed. So capital employed. And the formula for finding capital employed there, just look at the formula for finding capital employed. The formula that we use for finding capital employed, we say fixed assets. Fixed assets plus working capital. Working capital. And we have said that the formula for finding working capital, we have said that current assets minus current liabilities. So the formula that we use when finding capital employed, we say fixed assets plus working capital, and we know that working capital is equal to current assets minus current liabilities. And from our discussion, we said that the accounting equation, we said assets is equal to liabilities plus owner's equity. Owner's equity. And we have discussed about the assets, we have discussed about the liabilities, and we have discussed about owner's equity. So where you have questions, please ask in the group. So if you want to join our online teachers, they go at 100 kwacha per subject, and we provide the following subjects: physics, mathematics, chemistry, biology, accounts, and commerce. For more information, you can call me or text me on WhatsApp on this number, 0973023620. You can also text me on Telegram on the same number. You can also call me on this number, which is 0964286913. So let us continue looking at the balance sheet. Let us now look at the formatting of the balance sheet. So I've already drawn this formatting. So we have the title there. So the first thing that we're going to do, we're going to say fixed assets. Then we're going to have our cost here. Then we're going to have depreciation, and we're going to have net book value. So for the fixed assets, we know we can have plant and machinery. So we can have an amount here. And for this column, cost here, we only put in cost when we have depreciation. But in a case where we don't have depreciation, the cost of the plant and machinery is going to be placed direct on the net book value. And we know that depreciation, we can either have reducing balance or straight line method. So plant and machinery, then we can also have fixtures and fittings. So fixtures and fittings. So we can put our fixtures and fittings here. Then we can also have land. We can put our land here. So these are just examples of fixed assets. So for example, if we have these three fixed assets, we're going to find our total here. So we are going to add plant and machinery plus fixtures and fittings plus land there. Then we're going to have total fixed assets. So we can say total fixed assets. So this is the amount of our total fixed assets. Then we can say current assets. And for current assets here, we know we have stock. And stock, we mean closing stock. So we're going to put our stock here. Then we also have debtors. So for debtors, we put here. Then we have bank, which is cash at bank. Then we also have cash in hand. So this is going to be referred to as cash. So we can find the total there, and the total is going to be referred to as total current assets. Going to put our total here. Then we can say less current liabilities. In liabilities, we can have creditors. Creditors also referred to as account payable. So we're going to have creditors here. Then we are going to have bank overdraft. Bank overdraft recorded here. So you can find the total of this. And that means that we're going to have total current liabilities. So we're going to have total current liabilities. So this is going to be our total current liabilities. And here we can find the difference between the current assets and the current liabilities to get our working capital. So to find our working capital, we'll say the total current assets minus the total current liabilities. And we're going to have our working capital, and we'll put our working capital here. And that means that we can add our total fixed assets plus working capital to get capital employed. So we are going to add total fixed assets plus working capital, and we're going to have capital employed. So this is going to be our first answer, and we are going to say financed by. So financed by, then we're going to put our capital. So capital, we're going to put it here. Then we're going to say add net profit. So we can add net profit here. So we're going to say capital plus our net profit. We're going to find this figure. Then we can say less drawings. And drawings, we know this is the amount of money that is spent on personal use. So here we can say less drawings. So when we find the difference there, we're going to find net capital or capital owned then we can say add long-term liabilities, and these long-term liabilities we can have bank loan, so bank loan here, then we can also have debenture, so we can have debenture there. So we can find the total between bank loan and debenture, and we can say total borrowed capital or total long-term liabilities. So we're going to put our total borrowed capital there. So that means that we can add our net capital plus total borrowed capital there. We're going to have this figure. And you must take note that capital employed, which is this figure, must be equal to the last figure. And that means that your balance sheet has balanced, and that will prove that your calculations are correct. Where you have questions, please ask in the group. So let us now try to look at these examples. So we have the first example, and you can read the question on the screen. From the trial balance of Makoko extracted after 1 year's trading, prepare A, income statement, B, balance sheet. So we have Makoko's trial balance for the month of 31st December 2006. So we are having sales amounting to 190,576. Then we have purchases amounting to 119,834. Then we have salaries amounting to 56,527. We have motor expenses amounting to 2,416. We have rent amounting to 1,894. We have insurance amounting to 372. We have general expenses amounting to 85. We have premises amounting to 95,420. We have motor vehicles amounting to 16,594. We have accounts receivable amounting to 26,740. Then we have accounts payable amounting to 16,524. We have cash at bank amounting to 16,519. We have cash in hand amounting to 342. We have drawings amounting to 8,425. We have capital amounting to 138,066. And our totals on the debit side and on the credit side is 345,166. Then we have been given inventory. Inventory at 31st December 2006 was 12,408. And our first question A, we have been told to prepare the income statement. So for the income statement, I've already written the title. So the title is going to read Makoko's Trading Profit and Loss Account for the year ended 31st December 2006. So we're going to start by looking at the trading account. And for the trading account, we start with sales. So the sales figure there, it's 190,576. But before we record sales, we have to look at the question and we have to identify if we have sales retains or returns inwards. So we don't have returns inwards. That means that we're going to say our sales, we're going to put them at the end there since we don't have retains inwards. And the next thing that we're supposed to record, since we don't have retains inwards, we're supposed to record opening stock. So in the question, as you can see, we don't have opening stock. That means that we're going to record purchases. So we're going to say purchases. And before we record purchases, we also have to see in the question if we have retains outwards or purchases retains. So we don't have purchases retains. We also have to identify if we have any carriage inwards or wages. So we don't have that with the amount of 119,832. Then we can say less closing stock. And our closing stock figure, we are having 12,408. So we're going to find the difference. So we're going to say 119,832 minus 12,408. The answer there is going to be 107,424. So that's going to be our answer, and this is going to be cost of sales. That means that we can find our gross profit or loss, and considering here the sales is greater than cost of sales, that means that we're going to have gross profit. And to find our gross profit there, we're going to say 190,576 minus 107,424, and the answer there, we're going to have 83,152. So that's going to be our gross profit. So let us look at the profit and loss account. So let us look at the items in the trial balance. So let us identify if we have any gains. So we don't have any gains. That means that we're going to skip the part of gains, but we do have expenses. And the expenses that we are having, we have salaries, we have motor expenses, we have rent, we have insurance, we also have general expenses. So we can say less expenses. And expenses here we have salaries. So say salaries. And salaries amounting to 56,527. Then motor expenses. So motor expenses amounting to 2,416. Then we have rent amounting to 1,894. Then we have insurance amounting to 372. Then we have general expenses amounting to 85. And looking at the items that we have been given, these are the only expenses. So we can find the total. So we're going to say 56,527 plus 2,416 plus 1,894 plus 372 plus 85. We're going to have total expenses. And our total expenses there, we're going to have 61,294. That's going to be the total expenses. So we can find the difference between gross profit and total expenses. And when we find the difference there, we're going to have 21,858. And since this amount is positive, that means that this is going to be net profit. It's going to be net profit. So our net profit is going to be equal to 21,858. Let us now look at the balance sheet. So the first thing that I'm going to do when writing down the balance sheet is to put up the title. So the title there, we're going to have Makoko's balance sheet as at 31st December 2006. So that's going to be the title. And we can say cost, depreciation, net book value. Here we're going to have fixed assets, and we can put the initials for currency. So to identify our fixed assets in the question, let us identify the fixed assets. So what are we having? So the fixed assets that we are having premises and motor vehicles. So we are going to say premises. And since we don't have any depreciation, this amount is going to be recorded in the net book value column. So that's 95,420. Then we have motor vehicles. Motor vehicles amounting to 16,594. So 16,594. So we can find the total there. So we can say total fixed assets. So when we find the total there, we are going to have the answer that we're going to have is 112,014. So that's going to be our total fixed assets. Then we can say current assets. And for the current assets, let us identify the current assets that we are having in the trial balance. So for the current assets, we are having our stock. In this stock, you must record closing stock. So we're going to have stock there amounting to 12,408. Then the other current assets that we are having in the trial balance, we are having accounts receivable. So accounts receivable. So accounts receivable are also referred to as debtors. So this is amounting to 26,740. Then we are also having bank. So bank amounting to 16,519. Then we are having cash. Cash amounting to 342. So these are the current assets that we have in the trial balance. So we are going to find the total. So when we find the total there, we are going to have 56,009. So we are going to say total current assets. Then we can say less current liabilities. So less current liabilities. And the current liabilities that we are having in the question, we have account payable. So account payable and that's the only current liability that we are having. That means that we're going to record it here direct, and that amounted to 16,524. And finding the difference there, we're going to find the working capital. So to find the working capital, we're going to say total current assets minus the current liabilities. And the answer there, we're going to have 39,485. Then we can find our capital employed. To find capital employed, we're going to add the fixed assets, total fixed assets, and working capital. So we are going to add 112,014 plus 39,485. The answer that we are having is 151,499. So this is the figure that we are having. So we can continue this side and we can say financed by. So financed by capital. So what amount of capital are we having in the equation? So the amount of capital is 138,066. So having 138,066. Then we can say add net profit. In the net profit that we had calculated net profit of 21,858. So we are going to add there, in the answer that we're going to have 159,924. And since we have drawings, we're going to say less drawings. In the amount of drawings that we are having 8,425. And we are going to find the difference there. In the difference, we're going to get net capital, which is also referred to as capital owned. In the answer that we're going to have this answer. So we're going to have 151,499. And if you look at the questions, we don't have any long-term liabilities. That means that we can end here. That means that this is going to be our answer. As you can see, this figure in the figure for the capital employed is the same. That means that our balance sheet has balanced. So that's how you prepare the balance sheet. Where you have questions, please ask in the group. So this program has been brought to you by Jos Wale. If you want to get connected with me, you can actually check out my social media platforms. I'll meet you next time, and peace and God bless.